Hey, it's Ryan from the Option Income Advisor, and this is the trade of the day for July 12th, 2021. And as we're continuing our series on the top dividend stocks for the triple income wheel, these are stocks that not only pay a dividend, but we feel are trading at a decent valuation, and a stock that has some kind of tailwind behind it or stability to its industry or business that we think will allow us to run the wheel over and over on this stock over the next, say, 12 months, to where we can get, say, 3 to 4 times the dividend yield, pretty safely. Whether that's through just continued put selling, or we get filled or signed and write covered calls again on a stock that we feel comfortable owning. So the stock that we're going to talk about today is Qualcomm. You're probably familiar with this stock if you follow tech at all. This is the name in 5G. It's a semiconductor manufacturer, and they make a lot of the chips for 5G and just the 5G infrastructure. So this is a stock that not that it can't be volatile and can't go down, but it's certainly, there's a major need for its products out there. Is certainly as 5G gets adopted. So that's the type of stuff we like to look for in a true kind of triple income wheel type of company, right? I mean, we work so hard at building this huge list of stocks that we feel comfortable putting into the wheel, right? And Qualcomm is right there, in that wheelhouse, if you will. So this stock has above average rankings for dividend safety and value, which is great. That's certainly something we look for. And the strike zone we're looking at today is 118 to 132. And that's kind of driven by a few strike zone factors. 1, volatility, 2, pullback indicator, and then 3, the EPS risk. And so from a volatility standpoint, it's actually pretty decent on the volatility scale. So 7's almost in the green. It's almost an 8, 9, or 10. So it's right there, and so that just means that it's got lower volatility than most stocks, which is a positive factor on the margin of safety we need. From a pullback indicator standpoint, this stock has already pulled back about 16%, which is pretty decent compared to its implied volatility of 29. And so the pullback indicator of 9 just means that because the stock's already pulled back quite a bit, we should need less of a required margin of safety to transact. And then obviously EPS risk is EPS risk, and just so everyone knows, like we actually adjust for that in our required margin of safety. So when you see our strike zone, it's already factored in that there's some kind of earnings risk out there as well. And so that 6.9% required margin of safety is what drives this high end, this 132. But the range we're looking at is 118 to 132. So let's take a look at the chart, because that'll kind of help us feel more comfortable with the strike zone itself. So you can see this stock's been in an uptrend, as expected with most tech stocks, coming out of the pandemic. Been very strong within, in March of this year, tech had quite a pullback, and this stock certainly felt the pain as well. And so the low from that kind of March pullback was right around 123, and you can kind of see I've drawn these kind of range lines in here, and this is the range this stock has been trading in for basically the last 5 or 6 months. So basically 142 on the high end and about 123 on the low end. So it's literally been trading between 123 and 142. And if you look at our strike zone, so our strike zone was what, 130, about 132 to 118, right? So our strike zone's even a little bit further down from that range. So basically, what we're saying is and this is kind of a perfect backup to our the numbers in our strike zone. When we can see that this stock in particular that's been trading in a range, if it drops down to the bottom of its range, that's where our strike zone is. So that makes you feel comfortable, right? That makes you feel comfortable that, hey, I feel okay about writing a put in this at this level, because there should be some real support here. I mean, this level is obviously held twice, so we would expect it to continue to hold, or obviously the stock trade higher, which would be just as well for the wheel. So that's the chart. The strike zone kind of matches up with it, which is good. Dividend summary, we'll just cover that briefly. Again, this was a stock that met our high level criteria at one point. So our cutoff was 2%. So this one's at 1.92%. So it was kind of close enough. But this is a stock that, again, low payout ratio, about 35%, and it's had decent compound annual growth rates on the dividend growth. So it's a good dividend growth stock, just on the lower end of yield, which is fine, because when we end up owning a stock like this, it's kind of the dividend's a consolation prize if we end up getting a dividend while we're holding the stock, if necessary. So from a valuation standpoint as well, you can see earnings have come up quite a bit. So you can see just from the pandemic low, and these guys actually did okay. Earnings, sales came down a little bit, but earnings actually went up in 2020. And then now they're up quite a bit in 2021. And so when you look at their numbers on a forward basis, looks very attractive, right? And so a 16 PE on a forward basis seems extremely good for a stock like this. Their price to sales is right in line, and their enterprise value to EBITDA is just below. So from a valuation perspective, it looks pretty good. And this one also had a safety of 9, which you can kind of see in some of the stability as of late. I think this 2018, I think there were some one-time charges in there. So I think from a revenue and EPS standpoint, this has been a pretty stable company. And again, it's got some real drivers behind it. It's got a real reason to exist. And it's got an importance with this whole 5G rollout. So again, that's the high level, behind the short term view that we take with the cash secured put. So let's take a look at the puts and see what we got. So we're going to take a look at, again, 820. So you can see this one is a little bit out of whack here, because sometimes when we have random bid-ask spreads, what the software does is it takes the midpoint, right? So the midpoint is what they're saying is it's like $2, but that's not accurate. So what we want to look for is anytime you see this table, it should go down in descending order. So anytime one looks out of whack, it just means that the bid-ask spread is off, right? That they're just reporting a bad bid-ask spread here, because there's no way that there's a real ask out there of 450. So anyway, so we'll be focusing on some of these in the strike zone, right? So we've got this one right here, obviously meets our 1% average monthly yield. This one has a 8% margin of safety and a 21 delta. That's right, again, in our wheelhouse. We know it's in the strike zone. You can see I've already hearted it. I've already added it to my watch list. But this is one, again, meets all of our criteria. I think it's great for the base strategy. I'd be happy buying this thing at 130. That was kind of the towards the low end of that range. We can drop it down one on the conservative side. That's 0.7, only a 13 delta with a nice margin of safety. I like that from the conservative end. And then we'd go up one potentially for the aggressive, which again, it's probably in the lower end of the aggressive spectrum, but it does have a delta of 31. So given that it's reporting earnings, which is kind of driving some of that delta number right there, we still have a 4.5% margin of safety and that 1.7. So I think those trades, for the aggressive base and conservative, look pretty good for Qualcomm. And again, the goal with these stocks over time is, you write a put, hopefully in the right range, right? And it expires worthless, and then you just rinse and repeat. And that is what kind of gets you that whole wheel structure that eventually will earn you, should earn you 3-4 times what the dividend yield is. And that's and I would say on an even more conservative basis than owning the stock, because we're always investing with a margin of safety. And always, even if we own the stock, we're lowering our cost basis through the calls. So that's our trade of the day. Qualcomm. Let me know if you have any questions. Take care.